Welcome back to the Companies Act 2013 Masterclass by Corporate and Securities Law Compass. Before we begin today's lecture, let me ask you one interesting question. Can a company receive crores of rupees from a customer and still not call it a deposit? Surprisingly, the answer is yes. And if you don't understand these exceptions, you may answer MCQs and practical questions incorrectly. So, let's first revise what we covered in our previous lecture. In the last lecture, we studied Section 231 of the Companies Act 2013, read with Rule 21C of the Companies Acceptance of Deposits Rules 2014. We learnt one golden principle. Every receipt of money by a company is not a deposit. Whenever a company receives money, first apply the broad definition of deposit and then check whether the amount falls under any of the exclusions prescribed under Rule 21C. In the previous lecture, we covered the first 12 exclusions, including government receipts, foreign sources, bank loans, intercorporate loans, share application money, directors' money, debentures, employee security deposits, amounts held in trust, and business advances. But we had covered only the first part of business advances. Today's lecture completes one of the most important examination topics under Rule 21C. Today, we will continue with the remaining business advance exclusions under Clause 12. We will understand advances relating to immovable property transactions, security deposits for performance of contracts, long-term capital goods projects, warranty and maintenance services, and advances permitted by sectoral regulators or the government. More importantly, we will understand why these receipts are not treated as deposits, the conditions attached to each exclusion, practical examples, and the examination traps that students frequently miss. By the end of today's lecture, you will be able to identify whether a business advance is a genuine commercial transaction or whether it has crossed the line and become a deposit under the Companies Act. So keep your Bear Act, your study notes, and your notebook ready. Let's continue with Rule 21C and complete the remaining business advance exclusions. Before we move ahead, let me ask you one interesting question. Suppose a builder receives 10 lakh rupees as a flat booking amount, or a company receives an advance for a 5-year machinery project, or a customer pays for an extended warranty. Has the company accepted a deposit? Most students immediately answer yes, but the Companies Act says no. Why? Because these amounts are genuine business transactions, not borrowings. Let's understand the remaining exclusions under Clause 12. Clause 12b. Advance connected with an immovable property transaction. Suppose a buyer pays a booking amount for a flat under a valid agreement to sell. Will this become a deposit? No, because the money is paid towards the purchase of immovable property and will be adjusted against the sale price as per the agreement. For example, a real estate company receives 10 lakh rupees as a booking advance from a buyer and later adjusts it at the time of registration. This is not a deposit. Clause 12C. Security deposit for performance of a contract. Now suppose a contractor gives a security deposit before starting work. Is the company borrowing money? Again, no. The purpose is to ensure proper performance of the contract, not to raise funds. For example, a construction company collects a 5 lakh rupees performance security from a subcontractor. This is simply a contractual safeguard and not a deposit. Clause 12D. Advance under long-term capital goods projects. Large industrial projects often require advances before manufacturing begins. These advances help finance production and are a normal business practice. For example, A buyer pays a 20% advance for heavy industrial machinery under a 2-year supply contract. This advance is also not treated as a deposit. Clause 12E. Advance for warranty or maintenance services. Many companies collect money in advance for annual maintenance contracts or extended warranties. Will these become deposits? No, provided the service period does not exceed the normal business practice or 5 years, whichever is less. For example, a customer pays in advance for a 3-year extended warranty while purchasing a car. This amount is not a deposit. Clause 12F. Advance permitted by a sectoral regulator or government. Some industries have their own regulators. Telecom, power, insurance, and real estate are common examples. If a regulator or the central or state government specifically permits an advance, the deposit rules respect that sector-specific framework. Therefore, such advances are also excluded from the definition of deposit. Quick revision. Let's revise in 1 minute. Booking advance for a flat, not a deposit. Performance security, not a deposit. Advance for long-term capital goods, not a deposit. Advance for warranty or AMC, not a deposit, subject to the prescribed time limit. Advance permitted by a regulator or government, not a deposit. Remember today's golden principle. Whenever money is received as part of a genuine commercial transaction and not for raising finance, the Companies Act generally excludes it from the definition of deposit. Once you understand this principle, you won't have to memorize every clause. You'll be able to solve even tricky MCQs and practical case studies with confidence. Before we move ahead, let me ask you another examination question. Can a promoter give an unsecured loan to his own company and still avoid it being treated as a deposit? Or suppose you pay for a 1-year magazine subscription in advance. Or a Nidhi company accepts deposits from its own members. Will all these amounts become deposits? The answer is not always. Everything depends on why the money was received and under what conditions. Let's understand the next 3 important exclusions. Clause 12G. Advance subscription towards publications. Suppose you pay in advance for a newspaper, journal, or online publication. Has the publisher borrowed money from you? No. It is simply an advance against future delivery of the publication. For example, if a reader pays 1,200 rupees for a 1-year magazine subscription, that amount is not treated as a deposit. But remember one important proviso. If an advance covered under clauses A, B, or D becomes refundable because the company never had the required approval or permission to provide those goods, property, or services, the law becomes strict. If the refund is not made within 15 days from the date it becomes due, that amount is deemed to be a deposit. This is an important examination point. Clause 13. Promoters' unsecured loans. Now let us move to a very practical corporate situation. Banks often ask promoters to bring in their own funds before sanctioning a loan. If the promoter gives an unsecured loan only because the bank has made it a condition, will it become a deposit? No. The Companies Act excludes such promoter loans because they demonstrate the promoter's commitment towards the business. However, there is one very important condition. This exclusion continues only as long as the bank or financial institution loan remains outstanding. Once the bank loan is fully repaid, this exemption also comes to an end. For example, a bank sanctions a term loan only after the promoters infuse 20 lakh rupees as an unsecured loan. This amount is not a deposit while the bank loan continues. Clause 14. Nidhi company receipts. Finally, let us understand Nidhi companies. A Nidhi company is formed specifically to accept deposits from and lend money to its own members. Since these companies are already governed under the Nidhi rules, the general deposit rules do not apply. For example, if a Nidhi company accepts recurring deposits from its members in accordance with the Nidhi rules, those receipts are not treated as deposits under Rule 21C. Quick revision. Let's revise. Advance subscription for publications, not a deposit. Promoter's unsecured loan required by a bank, not a deposit, but only while the bank loan remains outstanding. Amounts accepted by a Nidhi company under the Nidhi rules, not a deposit. And never forget today's examination trap. If certain business advances become refundable because the company lacked the required permission and are not refunded within 15 days, they are deemed to be deposits. Remember today's golden principle. The Companies Act does not look only at the receipt of money, it also looks at the purpose, the conditions attached to it, and the regulatory framework governing that transaction. Once you understand this principle, even the trickiest MCQs and practical case studies become much easier to solve. Before we move ahead, let me ask you one final question. If money is collected under a chit fund, under a SEBI regulated investment scheme, or through a startup convertible note, will it become a deposit? At first glance, it looks like borrowing, but legally the answer is no. Why? Because these transactions are already regulated under special laws. The Companies Act does not regulate them twice. Let's understand the last three important exclusions. Clause 15. Chit fund subscriptions. Suppose a registered chit fund company collects monthly subscriptions from its members. Will those subscriptions become deposits? No, because chit funds are already governed by the Chit Funds Act 1982. For example, if 20 members contribute 5,000 rupees every month under a registered chit agreement, those subscriptions are not treated as deposits. Clause 16. Collective investment scheme money. Now suppose a company collects money under a SEBI approved collective investment scheme. Will that amount become a deposit? Again, no. Since the scheme is already comprehensively regulated by SEBI, the deposit rules do not apply. For example, a SEBI registered company pools investors' money under an approved agricultural land development scheme. This amount is not a deposit. Clause 17. Startup convertible notes. Now comes an important provision for startups. Suppose a DPIIT recognized startup raises money through a convertible note. Will that amount become a deposit? No, but only if certain conditions are satisfied. The amount received from one person in a single tranche must be 25 lakh rupees or more. The convertible note must either convert into equity or be repaid within the prescribed period. For example, if an investor invests 40 lakh rupees through a convertible note in a recognized startup, it is not treated as a deposit. But if the investment is only 15 lakh rupees, this exemption is not available. Remember this threshold: 25 lakh rupees or more in a single tranche. This is a favorite MCQ point. Quick revision. Let's revise everything in 1 minute. Chits. Revise everything in 1 minute. Chit fund subscriptions. Not a deposit. SEBI. Regulated collective investment scheme. Money. Not a deposit. Startup convertible notes. Not a deposit, provided the prescribed conditions, including the 25 lakh rupees minimum, are satisfied. Golden principle. Remember today's golden rule. Whenever a transaction is already regulated under a specialized law, such as the Chit Funds Act, SEBI regulations, or the Startup Framework, The Companies Act generally excludes it from the definition of deposit. Once you understand this principle, you won't need to memorize every exclusion. You'll understand why the law excludes it. And that is exactly how you score in MCQs, practical questions, and case studies. Before we move ahead, let me ask you one final question. Suppose a company receives 3 crore rupees from an alternative investment fund, or from a mutual fund, or from a REIT. Has the company accepted a deposit? It certainly looks like borrowing money. But legally, the answer is no. Why? Because these investors are already regulated by SEBI under a separate and comprehensive regulatory framework. Let's understand the last exclusion under Rule 21C. Clause 18. Money from SEBI registered investment funds and trusts. This clause excludes money received from alternative investment funds, AIFs, domestic venture capital funds, infrastructure investment trusts, InvITs, real estate investment trusts, REITs, and mutual funds, provided they are registered with SEBI. Why? Because these investment vehicles already operate under strict SEBI regulations, disclosure requirements, and investor protection mechanisms. For example, if a SEBI registered Category 2 AIF invests 3 crore rupees in a private company through a structured debt instrument, that amount is not treated as a deposit. And with this, we have completed all 18 exclusions under Rule 21C. Related definitions you must remember. Now, before we close this topic, let us understand two important definitions that are frequently tested in examinations. First, who is a depositor? A depositor means a person who has made a deposit with the company. Under Section 73, this generally refers to a member of the company. However, under Section 76, where an eligible company accepts deposits from the public, even a member of the public who makes such a deposit becomes a depositor. Remember this distinction. Section 73, members. Section 76, public, but only for an eligible company. Second, what is an eligible company? An eligible company is a public company which satisfies the prescribed financial criteria, such as the required net worth or turnover, and has obtained the necessary shareholders' approval before inviting public deposits. In simple words, not every public company can accept deposits from the public. Only an eligible company fulfilling the legal conditions can do so. This is one of the favorite MCQ concepts. Quick revision. Let's revise today's lecture. Money from SEBI, registered AIFs, InvITs, REITs, venture capital funds, and mutual funds, not a deposit. A depositor is the person who actually makes the deposit. An eligible company is the public company legally permitted to invite deposits from the public after satisfying the prescribed conditions. Golden principle. Today we completed one of the most important topics under the Companies Act. Remember one golden rule. The Companies Act does not classify a receipt as a deposit merely because money has been received. It always examines the source of funds, the purpose of the transaction, and the regulatory framework governing it. If you understand this principle, you won't need to memorize all 18 exclusions. You will be able to apply the law confidently in MCQs, practical questions, case studies, and real corporate practice. Before we conclude, let me ask you one final question. Suppose the examiner gives you a practical case and asks, is this receipt a deposit? Will you start memorizing all 18 exclusions? No. You now know the correct approach. Let's quickly revise everything we have learnt. First, we completed all 18 exclusions under Rule 21C. From government money, bank loans and share application money to business advances, promoters' loans, Nidhi companies, chit funds, startup convertible notes, and SEBI regulated investment funds, we understood why each receipt is excluded from the definition of deposit. More importantly, we learned that many exclusions are conditional. The 60 plus 15-day rule, the 365-day rule, the 25 lakh rupees threshold for startup convertible notes, the 1 year salary limit for employee security deposits, and the condition that promoters' loans remain excluded only while the bank loan is outstanding. Now remember the biggest examination formula. Money received, arrow, apply section 231, arrow, check rule 2, 1C, arrow, verify the conditions. If the exclusion applies and all conditions are satisfied, it is not a deposit. Otherwise, it becomes a deposit and Chapter 5 applies. Also remember, the examiner rarely asks you to reproduce the law. Instead, practical questions test whether you can identify the correct exclusion and apply its conditions. If you master this approach, most MCQs, practical questions, and case studies from this chapter become much easier. In our next lecture, we will solve more advanced practical case studies, examination-oriented MCQs, and tricky questions where students commonly make mistakes. If this lecture helped you understand the topic, please like the video, share it with your friends and colleagues, and subscribe to Corporate and Securities Law Compass. Also press the bell icon so you never miss the next lecture in this Companies Act 2013 Masterclass. Thank you for watching. I'll see you in the next lecture. Happy learning. Welcome to Corporate and Securities Law Compass. I am a member of the Institute of Company Secretaries of India, ICSI, and currently serve as a company secretary. The views, opinions, interpretations, and explanations shared on this channel are strictly my personal views and are provided solely for educational, academic, and informational purposes. They do not represent the views of my employer, any organization with which I am associated, any client, or the Institute of Company Secretaries of India, ICSI. The content is based on publicly available laws, rules, regulations, judicial pronouncements, and regulatory materials, or on hypothetical examples prepared for educational purposes. No confidential, proprietary, or unpublished information is used or disclosed. This channel does not provide legal, tax, financial, accounting, investment, or other professional advice. Viewers should consult qualified professionals before making any legal, business, or investment decisions. While every reasonable effort has been made to ensure accuracy, laws and regulations are subject to change. Accordingly, neither I nor this channel accepts any liability for any loss or consequences arising from reliance on the information presented. All trademarks, company names, and logos belong to their respective owners and are used only for educational, commentary, and informational purposes. Copyright, Corporate and Securities Law Compass. Navigating law with clarity. All rights reserved.